Welcome to the trend trading and reversal trading video. My name is Ade. I'm a trader, mentor, and author of the Trend Trader's Guide to Success, how to get on the right side of Forex, metals, indices, oil, and crypto trends. And in this video, we'll start off with the differences, the similarities, and the issues with trend trading and reversal trading.
Snapping them order.
So we'll start with the differences. Entry points. With trend trading, entry points involve entering trades in the direction of the prevailing trend, usually after a pullback or consolidation. As you can see here, the candlestick crossed and closed on the other side of the moving average, which is this yellow line you can see on top of the candlesticks. And every candlestick thereafter resulted in a lower low and a lower high. And that carried on until this candlestick here, which could be the early sign of a reversal in the trend. As far as reversal trading is concerned, this involves entering trades at potential turning points. And these three circles show you the three potential turning points in this trend. You can see that price was rejected every time it touched the moving average. And this is a potential clear reversal only if price or the candlestick crosses and closes on the other side of this trend. So we won't know what happened in this instance, but these are the areas where reversal traders try to get in. Risk management. As far as trend trading is concerned, risk management often is a major part of trend trading, and trend trading employs trend following techniques and momentum indicators to manage risk. Reversal trading, on the other hand, focuses on identifying key reversal signals and may involve tighter stop loss orders to manage risks in case the reversal doesn't materialize. So the time horizon of trend trading typically has a longer time horizon as traders aim to ride the trend until signs of exhaustion or reversal. Signs of exhaustion are candlesticks moving sideways as opposed to higher highs and higher lows. This happened over 1, 2, 3, 4 candlesticks, but the fifth candlestick broke this barrier, and we can see here at this point 1, 2, 3, 4, 5, 6, 7 candlesticks moving sideways. We finally got an engulfing candlestick here, and this is a potential reversal. I say potential because we can't see what happened beyond this candlestick. As far as reversal trading is concerned, reversal trading can have a shorter time horizon as traders seek to capture price movements during periods of trend reversal. So we can see here price crossed and closed above the moving average. This is a potential reversal. However, this candlestick was rejected and price carried on in the prevailing trend. Sideways movement in candlesticks, reversal, bounced off the moving average, and the trend carries on. So the time horizon for reversal trades, as you can see, are shorter than the trends. Indicators. As far as trend trading is concerned, trend trading utilizes trend following indicators like moving averages. The moving average is this yellow line you can see. One of my main indicators I use to determine whether or not to buy or sell. Price crossed and closed above and stayed above the moving average all the way to the top. As far as reversal trading is concerned, reversal trading relies on reversal indicators such as candlestick patterns or chart patterns to signal potential trend reversals. Of course, you can also use moving averages. You can see here the moving average is the yellow line. Price crossed and closed above the moving average. And the second indicator, a two-line cross indicator, when the green line crosses above the red, it's a signal to buy. When the red crosses above the green, it's a signal to sell. But these two indicators need to correspond for you to do anything. So price crosses and closes above the moving average. The green line crosses above the red. That's your signal to buy. And this ends up in a nice trend. However, we get an engulfing candlestick in the opposite direction. We get the red line crossing above the green, and we can also see that this shows price moving sideways. If you take a short signal, this could have ended up being profitable, maybe somewhere around here. However, the trend carries on this cross of the green and the red. Similarities between trend trading and reversal trading. We'll start off with risk management. Both approaches emphasize the importance of effective risk management. Setting stop loss orders and managing positions are crucial elements in both trend and reversal trading. Technical analysis. Both methods heavily rely on technical analysis to identify entry and exit points. Traders in both camps use chart patterns and various technical indicators, like I've already shown. Psychological discipline. Successful execution of either strategy requires discipline and emotional control. Traders must stick to their predefined plans and not succumb to impulsive decisions. If you've been trading for any amount of time, or even if you're new to trading, you should know that psychology is one of the biggest problems traders have. It's one of the biggest hindrances. Adaptation to market conditions. Both trend and reversal traders need to adapt to changing market conditions. Markets can transition from trending to ranging and vice versa. And this requires traders to adjust their strategies accordingly. If the trend is bullish, I follow the bullish direction. If the trend suddenly changes and becomes bearish, I close my long trade and I go short. Use of confirmation signals, i.e. not using indicators on their own. Both approaches benefit from confirmation signals. Trend traders may wait for a pullback to confirm the strength of the trend, while reversal traders often seek additional confirmation before entering a trade, and this is advisable for anyone. We now look at the issues in trend trading. First is false breakouts. The challenge is that trend traders may experience false breakouts where price movements seem to signal a trend continuation but ends up being a short-lived move. And we can see this where we have a bearish trend. We have an engulfing candlestick in the opposite direction, which also crosses your moving average. So if you're only using the moving average as your buy or sell indicator, this will be your indicator to buy. However, on the third candlestick, we can see that price crosses back in the opposite direction. And if you decided to sell here, you'd have made profit, as we can see. However, you now get a long entry. So if you entered here, this is the amount of pips you actually keep. Even though price went from the bottom of this candlestick to the bottom of this one, it reversed and then took some of the profit away. If you went long, you need to close that trade and go short immediately after. So you should be aware of false breakouts. Don't just stick with a trade because you assume it's going to be a trend, because it's not always a trend. You can mitigate the false breakouts by using additional confirmation indicators and waiting for sustained price action, and this can help reduce false signals, but it doesn't always work. It just helps you minimize how many false signals you're actually taking. Second issue is late entries and exits. The challenge is identifying the exact start and end of a trend. And trend traders might enter late, missing some initial gains, and exit late, giving back profits. That's inevitable. But we can see here that this was a good entry. You know, we enjoyed a few pips if we took this trade. However, on this one, we can see that this candlestick basically signified the end of the trend. So if your buy or sell signal is only your moving average, you can see here that it didn't play very well on this occasion. When price crosses back in the opposite direction, we saw a reversal within two candlesticks, which would have meant closing this trade at a very minute loss. If we decided to go long here and close the trade here, this would have been a small loss as well. So two small losses followed by a nice trend. You can mitigate for late entries and exits by combining trend following indicators with other tools for timing entries and exits can improve your precision. Issue number 3 is whipsaw markets. The challenge is in choppy or sideways markets, trend following strategies may result in frequent false signals and whipsaw trades. We can see here sell, buy, sell, buy, sell, buy, sell. So you need to find other indicators which will keep you out of these losses. Now, you won't know a trade will be a loss until after you've entered it, but with the right indicators, it should keep you out of this one and potentially this trade and this trade as well. So this one, this long trade, and this short trade. So you have 1, 2, 3 trades that obviously didn't end up in a trend. So by combining indicators, you filter out these trades potentially. To mitigate this, as already mentioned, you use additional filters or opting for a different strategy during ranging markets, which can help avoid unnecessary trades. The only problem with ranging markets is you don't know it's ranging until after it's in the range. And this usually involves entering a number of trades, not hitting your targets, and then realizing the market's actually moving sideways as opposed to trending. The markets range more than they trend, so you need a strategy that prepares you for this. And like I've already said, you often don't realize the market's ranging until after it stops, and you should always assume the market is ranging, and you can use buy and sell stop orders to prepare for a breakout. Issues in reversal trading. Number 1, early entries and false signals. Reversal traders may enter too early, mistaking a temporary pullback for a full trend reversal, and false signals can lead to losses. As we can see here, this is a reversal, but it got rejected and price continued in the prevailing trend. This was a reversal, false breakout if you ask me, and price continued until crosshair as well, and then finally it crossed and broke the moving average. To mitigate for this, you need to wait for multiple confirmation signals and use a combination of reversal indicators to reduce the likelihood of early entries or false entries. Issue number 2 is low probability setups. Quality reversal setups are relatively rare compared to trending markets, making it challenging to find high probability trades. However, if you backtest, this should help you identify. The mitigating of this low probability setup will involve being patient and selective and focusing on the highest quality reversal signals. Consider combining several signals with other confirmation factors. This is where backtesting is very important, because when you backtest, you'll be able to see the combination of indicators that give you the highest probability trades. Number 3, psychological stress. The challenge is reversal trading can be mentally demanding, reversal or trend trading, especially during strong trends where the market seems to move against the trader consistently. Mitigation involves maintaining discipline, sticking to the trading plan, and being aware of the psychological challenges associated with trading against the prevailing trend. General challenges, trend trading and reversal trading. Adaptability. The challenge is that markets can switch between trending and ranging conditions. Traders using a single strategy may struggle to adapt to changing market dynamics. Mitigation involves staying informed about overall market conditions and consider adjusting your strategy or using a combination of strategies where necessary. Over-optimization. The challenge here is excessive optimization of a trading strategy based on historical data may lead to poor performance in live markets. And this happens because during backtesting, you often don't factor in trades you wouldn't have entered because of news, even if the trade went in your favor. To mitigate for this, regularly review and update your trading strategy to ensure its relevance in current market conditions. Third challenge is market noise. And both trend and reversal traders can be affected by market noise, which may generate false signals and impact overall performance. To mitigate for this, you use a combination of technical indicators and filters to reduce the impact of market noise in your trading decision. General challenge number 4 is risk management. And the challenge is inadequate risk management can lead to significant losses in both trend and reversal trading. To mitigate, prioritize risk management, set appropriate stop loss levels, and diversify your portfolio to manage overall risk. As already mentioned, I trade Forex, metals, indices, oil, and crypto. And as a general rule, I try to be in only one of those instruments at any one time. In conclusion, be aware of these challenges and continue learning. Refine strategies based on experience and market conditions. Incorporating solid risk management practice is crucial for navigating the uncertainties of the financial markets. If you've enjoyed the video, please give it a thumbs up. If you have any comments, put it in the comment section below. And I'll put a link in the description to get my book, The Trend Trader's Guide to Success, How to Get on the Right Side of Forex, Metals, Indices, Oil and Crypto Trends on Amazon.